All right, ladies and gentlemen, Finom Group members, our general YouTube audience, and all investors from around the world. Welcome back to Finom Group's State of the Market. As usual, I am your host, Seth Golden, and I'm actually joined, my co-host for today will be Brad Carter. Brad, welcome. I know this is your first co-hosting experience with State of the Market, and I want to thank you for it. Just as a brief background, who's this guy, for many of our Finom Group members and audience. Brad is an investor. We actually met in 2011 when I was running Capital Ladder Advisory Group, and we've been investing and trading together ever since, haven't we?
We have.
Yeah. So I know you're weathering the storm pretty well this year in 2022. Can you give us kind of a, how you've been able to manage both your portfolio as well as your emotions through this period?
Yeah, and I've been doing it long enough now that I kind of know what my pain threshold is, in a
Yeah.
psychological sense. And so, like I mentioned online once in a while, I'm always saying to myself, don't get over your skis.
Yeah.
That's just the main thing. If you miss one, what the heck, you don't have to buy every dip, and all that kind of just real. I call it aggressive discipline.
There you go. There you go.
You want to stay real engaged, and you like to say take your shots. That's a good way of putting it. And not every shot's going to hit, but but if you'll just stick to a game plan, you're going to do more right things than wrong things in the long run, and you just have to trust in that.
I love that you said aggressive discipline. It's actually the quote that I have up here to kick off our SOTM.
Really?
We did not rehearse this. This was not rehearsed.
But let me tell you, looking back where I think I messed up a little bit, but to be fair, hindsight's 2020.
Yeah.
I probably too aggressively bought into the TQQs, as it was going down a little bit at a time, but I didn't foresee it being as deep as it went.
Right.
And so I backed off, but I have not sold a share of that. I've kept it. It's fairly high. I have a feeling our books look kind of similar on that. I don't know. I hope yours is a little bit better.
I think anybody in growth or the Qs, I think anybody who's holding that position, that's probably their most underwater position. Anything related to growth, FanMag, and the Qs, the NASDAQ, that's probably the worst position that they have in their portfolio.
Right. But then you're also sticking with this aggressive discipline. You're going to have some luck once in a while too. I told all of you guys that I was buying Oxy in the 19s and 20s. I was expecting it to go up, but I wasn't looking for $100 oil or $70, $75 a share kind of stuff.
Right. But you can only do that by staying disciplined and engaged.
Yeah, and I still own it, but I own far fewer shares. I think energy's still good for a little while.
Yeah, I think at least toward the end of this year, first quarter, until possibly we get some movement on the. When I say movement, I mean some positive developments on the Russia-Ukraine front, as well as just catching up with capacity utilization within the oil complex. So there's probably at least 6 more months of reasonable commodity returns. I don't know if they'll be specifically energy or soft commodities, cotton, wheat, things like that, but I don't think the commodity boom is over yet. But I think the best days of the commodity boom are happening here in 2022.
Definitely.
Yeah. So, I mean, from that perspective, I guess I would say that your profit taking has been well warranted.
Yeah. And then the final thing I think that turned out to be a pleasant surprise during this, I I keep looking at it as a orderly downturn, and I know you don't like it looking at, but the only reason I say that is look how good the UVXY has behaved.
Right.
And it's just been incredible, and that's been
it hasn't been a black swan. It hasn't been out of left field. It's just been this constant drip and drag, to lower prices. Yeah. And it's all predicated, this is a derating cycle. And in a derating cycle, people see what's coming. So they make more probabilistic choices, which is, look, I know if the Fed is tightening, the PE multiple is going to go down. The equity risk premium is going to make equities look less attractive. So it's just easier for me to sell than to hope with a hedge. And so you just haven't had the hedging activity that is normally associated with a bear market. You don't have folks fighting it, so to speak.
Yeah, that reminds me, I've been wanting to ask you, do you think that we've entered a new long-term trend where people have just figured out that the UVXY is just not a good hedge instrument, and that's part of what's going on here?
I think every cycle or regime has its own nuances. This one has its own nuances, unlike, just like any other one. This is specifically a derating cycle. I think there will be more people that learned that these particular derivatives, VIX exchange traded products, are not good hedges. They can be, to a certain degree, a hedge, but you got to time it. You got to, have the in and outs done really well. So yeah, I would agree that there's going to be a lot more people that disassociate from trying to go long as a hedge against their long equity exposure, the likes of UVXY or VXX. And so, and we are in a regime where, while they're not, using those products so much as a hedge, what we found in our research is that more people are just buying put options on a daily basis, as opposed to using sexy derivative products like UVXY, not having the additional leverage and whatnot. So they're just buying puts on a daily basis as their means of hedging. Or on some occasions, we've seen VIX options, being bought, but it gets quickly unwound. So even that hasn't proven a good hedge either for, this particular regime. But that is fuel, it is fuel for, what is inevitably going to turn into a new bull market, lesser volatility, and even more downside in UVXY in the future. It wouldn't surprise me if at some point, we have a new bull market in possibly 2023 that we're once again facing a reverse split on UVXY, which I think is number 10 or 11. I mean, that in and of itself should tell traders that these are not good hedges. You don't want to be long with them. You want to go short them, and just give yourself time. Keep the position size small. To your point earlier, not getting out over your skis with any particular trades as you're taking your shots throughout the year. Just keep position sizes small. You give yourself more time in the trade for the inevitable profit. So so I want to get into the meat of our SOTM, but great, great to have you here, Brad. Nice to see a smiling face as opposed to mine and my Boston Celtics hat. Anyways, so everyone must choose one of two pains. And here they are. Here's your choices. As an investor, you got to choose one of two. The pain of discipline, which you expressed earlier. It's not easy to be a disciplined investor or a trader, but your other option is the pain of regret. Like, if we're not disciplined, if we take, position sizes that are too big, well, we're probably going to find some regret in the way of capital losses, because the bigger the position, the more intense, the more anxiety that someone's going to have around that position when it goes against them, which is why you have a constructed game plan. Small positions, especially in a bear market. You don't want to get out over your skis, as you said earlier, Brad. So these are your choices. It's either the pain of discipline, which I'd rather suffer that pain than the pain of regret by, just having too big of a position, yielding too big of a draw. All right, lost this connection there for a second. Wi-Fi in Florida, they just don't go hand in hand, especially when we have bad weather. Anyways, catching up. Here's something else that I liked, a saying from, or a quote from Jim Rohn. If you're not willing to risk the unusual, you'll have to settle for the ordinary. Everyone must choose from one of two pains, pain of discipline or the pain of regret. Now, coming into today's trading day, we kind of got lambasted by Fed officials once again. Pretty much all year, we've promoted the what has proven to be true, which is this notion that the Fed is going to do everything that it can do to contain the wealth effect here in 2022. So even though we've gotten some really good CPI, PPI, just inflationary prints recently, it doesn't mean we're out of the woods. Why? Because the Fed still has a job to do, and it wants to see this disinflationary trend. So one CPI report coming in far better than expected, one PPI report coming in far better than expected does not necessarily make a trend. And so we have to be aware that if the market does start to get exuberant, trending towards that 4,000 level, probably going to have Fed officials come out and start to throw water on those good disinflationary prints until they become a trend, until we get into the first quarter. I said just as much in this tweet here on October 4th, and I reiterated it on November 10th. Are you ready? Remember, their job is to contain the wealth effect and get us into Q1 where the greatest disinflationary prints will be likely found. Until then, cold water on 2022's disinflation progress. So first thing this morning, we had Fed President James Bullard come out and he started cursing. He was using foul language. He mentioned that we may have to be in a range of 5 to 7% Fed fund rate. And I say that 7 is the S word. Okay, that's cursing. If you put that, it's the equivalent of cursing. The market has basically priced in 5% terminal Fed funds rate. And you're going to come out and say, well, a range of 5 to 7%, that's the equivalent of cursing to me. And the market didn't like it. Immediately we saw the future start to tank. We opened up in down 180 points on the NASDAQ, down almost 40 on the S&P 500. And we saw the bond market, also pick up on these comments from Bullard. We saw the 10-year jump 10 basis points, the 2-year yield jump 10 basis points. I mean, all markets are reacting to what the Fed says. The Fed knows the markets will react. And that's what I mean about you just can't get over your skis here and start, anticipating 4,300, 4,400 like some strategists are out there suggesting. And don't get me wrong, it can happen. I just would be cautious about positioning for that until we're possibly in the new year. So what do you think about that, Brad?
That's where I'm at. Right now, you just got to take what the market gives you.
Yeah. Day by day.
And I have never kept as much cash as I'm keeping now.
Yeah, I'm in the same boat. Yep.
I think the lowest it's gotten since all this turmoil is like 25%, and sometimes it's as high as 50%.
Right.
I just don't mind that because I've somehow managed to get a little better than even for the year.
Awesome.
And that's got me even being maybe a little bit more conservative. Don't give it away again.
Right. Well, that's great cash management. It's one of the things we promoted here. Just manage cash wisely, take your shots, and take your profits. In a bear market, in a downtrend, if you got a profit, take it. Because we've seen, the market unwind rather quickly on this headline or that headline. So good on you, sir. Last week, we talked about the fact that, and based on this chart right here, Since 1928, the S&P 500 has never actually bottomed before a recession. And that's all fine, well, and good. But at the same time, we've also talked about this chart, which shows we've never actually had a decline this big before a recession. These are all the monthly peaks before. So these are the monthly peak drawdown before a recession. Most of these are in the single digits. The worst one before a recession was actually 18%. This is the S&P 500, and that was 2000 into 2001. This one is 25% on a closing basis. We all know it was 28% on a peak to trough intraday basis. So, I kind of hope everybody keeps an open mind. While this is a fact, the market has never bottomed before a recession, and we haven't had a recession, even though everybody's calling for a recession in 2023, we also have never had this size of a drawdown before a recession. So two things can be true at the same time, and we still yet don't know what the future holds. As I always suggest, keep a glass half full mentality at all times. And if you get a better price in the future, take advantage of the better price. The other thing to consider is we don't know when the recession starts until well after, because the National Bureau of Economic Research, NBER, they're the ones that call the official recession. And this note here from Mark Ungwitter, he says, the S&P 500 has never bottomed before an official recession, but has often bottomed before an official recession is announced. So if you just a recency bias, the pandemic of 2020, they didn't call the recession start or end until the summer of 2020, when the recession was already over and the market had already rebounded some 20-25%. So a lot of this, these charts that propose to be, very bearish and pessimistic about the future for the S&P 500, they don't lend a lot of practicality. Like, what can we do with them? That's what I often ask myself when I'm looking at a chart, when I'm reading, the verbiage and understanding the context. What can I actually do with it? And so, to your point, you've never kept, such high cash levels, right? And so I look at it and I say, well, this just gives me an idea of where my cash levels might be. It doesn't tell me to buy or sell. It just tells me, with this kind of uncertainty and these kind of conflicting data points, I probably just need to have more cash on the sidelines just in case.
Yeah. Your comments on recession reminded me in 2008, spring semester, I was teaching a sociology class. And I remember telling my students, I said, I think we're in a recession. I think we're right at the front of one. I said, but get back with me in the fall and I'll confirm it for you. Sure enough.
Good stuff. And just to give folks a background, you were a collegiate professor, correct?
Yes.
Gotcha. In Texas, right?
Right. I didn't retire until January of this year.
Right. I recall. So this next chart right here, sequence of market pricing and economic recessions. So across 12 experiences since World War II, these are the dates, all the 12 recessions going back to 1948, the equity market has begun to price a recession on average 7 months prior to the official start of the recession. That's what this is here. Market peak to recession start pricing. So about the market starts pricing the recession on average 7 months before a recession starts. The NBER has announced the official recession an average of 8 months after they begin. So you may be 8 months into a recession before the NBER even announces the recession. And it can take as long as 16 months from when the recession ends for the NBER to announce the recession ended. So again, all this talk about recession and where the S&P 500 will bottom and start to climb, because we know it tends to bottom about 4 or 5 months before the recession actually ends. Again, there's just not much you can do in the way of timing. We have this data, but we don't know when the NBR is going to do and say what they're going to say. This table here is very similar, to this one right here. The challenging part is waiting. And that's the difficult part about 2022. Every day we hear the recession is going to start in Q4. No, it's going to start in Q1 of next year. Well, maybe the second half of 2023. And everybody's on pins and needles waiting for the recession. That's the hardest part. On average, the NBER does not call a recession until 15 months after the recession is over. That's this chart, months after the recession is over. Essentially, you are going to be in limbo so far as where you are in the recessionary cycle until far after it's over. Essentially, what I would tell investors to do with this kind of information is accept that the market leads the economy. So if the market is going up, if we're above the 200-day moving average, you technically have a new bull market. We have data suggesting that as well. Here are the past S&P 500 closes above the 200-day moving average after spending at least 143 days below the 200-day moving average. So every time, these are the amount of days, total days below the 200-day moving average, but then we cross above it. 6 months later, almost every single time the market was higher. 12 months later, almost every single time the market is higher. So that's the market telling you you're probably out of a recession. If you wait for the NBR to tell you, you waited too long and you're letting these double-digit gains get away from you. 90% of the time you get back above the 200-day moving average, it's a new bull market, and we're probably starting an expansion cycle. You gotta act. Here's a chart showing you on average, and these are all the recessions going back to 1948, the market tends to bottom 4 months before the recession end date. And so it's not just that the market bottoms before the recession. Look at the gains off of the bottom until finally the recession is called over. And then the gains that come thereafter. And that's the thing, for all of these, well, you don't know if we're going into a recession, but we do know that the market doesn't bottom before a recession. It doesn't matter. What matters most is how much cash you have on the sidelines and how your game plan takes into consideration these different variables by being disciplined. Look, I'm not going to chase this move up to 4,000 in the S&P 500. There's too many macro fundamental situations that are deteriorating. Will they lead us into a recession? I don't know. It depends on how they progress going forward. So I'm not in the business of chasing this rally with long-term capital. I'm buying deep value today where I see it in the market. I see deep value in growth. How can you not? NASDAQ down 30%. FanMag stocks down 50, 40, 70% in some cases. But so far as the S&P 500, I'm not in the business of chasing it up to 4,000. I'd rather just continue with my game plan because I don't know what's on the other side of, the turn of the year, if you will. So that's kind of my game plan here, just to stay diligent, disciplined, take my shots, but maintain what I want in the way of cash. We've seen this chart right here many a times in past State of the Markets. This is a Goldman Sachs chart, and it teaches us about, during the past recessions, the median drawdown of all the past recessions has been 13%. What we haven't seen is the median return in earnings. So this is the median drawdown in earnings. This is the median draw up in earnings after the recession. So what's interesting here is the median drawdown in EPS, earnings per share. All right, we keep getting disconnected here. I mean, I do have bad weather here in Florida today, so it's playing around with my Wi-Fi. So just to reiterate, this is a chart from Goldman Sachs, past recessions in the S&P 500 earnings per share drawdown. The median is 13%. Now, the draw up coming out of a recession, the median earnings climb is 17%. So the drawdown is less significant than, the bounce back in earnings. And that's why it is so important to recognize when the market has bottomed and is starting its ascent, and why the market tends to bottom before the recession is even over. Because the market is a forward discounting mechanism, and it's pricing in that earnings rebound here. This is another chart from JP Morgan, kind of the same thing. Equity market returns by the time that the GDP is bottomed, or by the time the recession has hit its trough point, the equity market, or the S&P 500, has already rallied in each of these circumstances, each of these recessions. Market has already rallied 20% before the recession is over, 25% in 2009, before the recession is over, 23%, so on and so forth. This is the S&P 500 return by the time that GDP started rising. 30% already, the S&P 500 is up, 44%, 20, I mean, double digits across the board, basically. So again, cash on the sidelines. Don't wait for the National Bureau of Economic Research to say, oh, by the way, the recession's over. I mean, you're still going to have bad economic data, but it's probably less bad. And if the market is rising, and if it's over its 200-day moving average, the market is telling you that we're trending out of a recession already. I thought this was interesting. This is from Bridgewater, Ray Dalio at Bridgewater. It basically outlines Bridgewater recent report titled "How Conditions Today Compared to Past Equity Market Bottoms," and he gives all these different. So these are the recent, from goes back to 1966. Past equity market bottoms, inflation high. Here's today. Yes, it's very high. Economic weakness, it's moderating. We have tight levels. Is the Fed easing underway? Slowing, tightening, so it's not easing. Long-term equity expected excess returns, low. And basically from these different criterion, he's saying we're not at a bottom yet. We need all of these to be green for it to be a bottom, by how Ray Dalio characterizes bottoms in bear markets. Yield curve priced in inflation. Now we're pricing in a recession. I think it's safe to say that the yield curve has already priced in inflation, at least 95% of it. But when we start to see the 10-year roll over, as it has recently, going from 4.25% to below 3.8%, that's usually the bond market, or the yield curve, starting to price a recession. It's done with inflation. Now it's starting to price a recession. We've seen it in 1984. Bond market, which is in the green here, 10-year yield rolls over even before the Fed has stopped tightening. But it's usually around the same time that the S&P 500 is bottoming as well. And maybe we have seen that this year also. S&P 500 bottoming in October, 10-year yield hitting its high in October, and now rolling over. We saw the same thing in 1994, 95. 10-year peaked, rolled over, yields, the Fed fund rate stopped going up, but almost at the same time as yields, S&P 500 bottomed as well, 1994-95. Example here in 2018-19, yields peaked, rolled over, S&P 500 bottomed, just about the same month. Fed stopped hiking. So, usually when the 10-year yield blinks, it's because it's moved from inflation, the Fed hiking to fight inflation, to now pricing a recession. It doesn't mean the recession will come, but essentially, investors want a flight to safety. They're the ones that are distinguishing between, the Fed is done, or we priced in inflation, but inflation ultimately leads to recession, so now we're pricing that in, which tends to benefit stocks. In these cases here, where it happened, where the Fed was tightening in 84, it did not lead to a recession. 94, 95 did not lead to a recession. 2018 to into 2019 did not lead to a recession. So not all Fed hiking cycles are created equally, but essentially, people think we're always going into a recession. The first year into an expansion cycle, people start pricing in the next recession. It's just the way things work. Yields peak at or before the end of the tightening cycle. So just like the equity market, the bond market is a forward discounting mechanism as well. And here's the other situation that's developing right now, which is raising the recession probabilities. We talked about this a couple weeks ago. The 10-year minus the 3-month Treasury yield curve, which inverted a month ago. It's still inverted. It's inverted to the tune of almost 50 basis points. And a lot of folks don't understand, well, why is this the recessionary part of the yield curve? Why do so many folks pay more attention than this to this yield curve rather than the 10-year minus the 2-year yield? What I would say is people pay attention to whatever they think is popular or whatever somebody taught them. But there is some, practical understanding that this is highly relevant and somewhat of a recessionary signal. When you deposit money in the bank is giving you an interest rate. It's giving you an interest rate at the 3-month, the short end of the curve. Now, that money that you're giving the bank, essentially loaning the bank, they're able to loan out to somebody else, some other business or whatever. And they're loaning that out at the long end of the curve. So essentially what the bank wants, what is most attractive for a bank to lend, is when they take your money in and they pay you less, but charge the person they're lending it out to at the long end of the curve, charging them more interest. When it's the reverse, the banks don't like to lend as much, and they raise credit standards, make it tougher for an individual applicant to achieve the loan. And so when there are fewer loans, being distributed by the banks, there's less cash through the economy. Hence, you have slower economic activity. And if it doesn't, turn around, or the yield curve doesn't uninvert quickly enough, you can find yourself in a recession. And so that's why people pay so much attention to this part of the yield curve. What we do see here is while this has been inverted for a month, the average lead time to the recession can be 24 months. And what I often say to people is, please stop. If the average lead time is 20, anything can happen in 24 months. This doesn't necessarily cause it. It doesn't help lending, but it's not going to be the cause of a recession. It can contribute, but you need a whole host of other things, to coalesce and bring that recession together. Because something that has a lead time of 24 months on average, sorry, that's not a recessionary signal. That's my take, Brad. What's yours?
What this got me to thinking of, if you go back to that 2018, 2019 period, what's interesting for me personally, anecdotally, is that was by far my best year in stocks, 2019, by far.
Yeah. Yeah, I did 40+%, I think.
That was that year I hit
2018 stunk.
Yeah. And 2019 was, I'm going to say, was 132% or something like that.
Yeah,
it was well over 100%. It was crazy.
Yeah, you had my 2016 year. Yeah.
Yeah.
But that's how it happens. I mean, you get these drawdowns. You get the Fed to pause. The Fed paused in 2019, stopped hiking rates. We avoided a recession. We kind of had this very similar setup this year. We are anticipating a Fed pause in the new year. The exact timing remains to be seen. But if certain segments of the economy continue to deteriorate, housing, manufacturing, ultimately the Fed is going to wake up and recognize, by the way, we have tackled inflation. It is coming down materially. They'll have that come Q1 of next year, and it'll give them the confidence and ability to pause rate hikes, look around, see how things develop in the next couple of months, to see if there's any additional policy necessary. So there is a path, as Goldman Sachs also said, there's a path to a soft landing. It's actually a pretty reasonable path at that, but it does all, demand Fed attention and a tactical approach. They have to be willing to pause. They have to, see the data, be able to project out that inflation is going to come down rapidly, especially in Q1 of next year, when the rent inflation finally manifests in the data. The better than expected CPI that we got 2 weeks ago didn't even have good rent inflation data in there, meaning that it didn't show a deterioration. It slowed, but slowing leads to eventually we're going to have the negative owner's equivalent rent and shelter in the CPI. And the Fed knows all this. But that's why I go back to the tough talk that we are getting from the Fed since the inflation prints are really just to make sure the animal spirits don't come back in the market. And speaking to recession probabilities rising and why we do have to be cognizant of how we approach, the seasonal tailwinds in the market this time of year by maintaining respectable cash levels is because, tomorrow we're going to get the next leading economic index report. It's going to be down again. And it's going to effectively be down 8 months in a row, which hasn't happened since 2006. Generally, when you get, 4 or 5 months in a row, you're on the precipice or you are in a recession. That's what the gray lines are, recession. And you can see LEI, spikes up. These are how many months in a row that the LEI is negative. Here in 1970, 7 months in a row, negative. Here, 1974, every month, 1973 to 74. But there has been a time in 2006, the LEI was down 8 months in a row, and yet we didn't have a recession until late 2008. So could this be a similar circumstance? It could be. There is precedence. But even so, negative leading economic indicators, 8 months in a row, is not good. It's telling you there are pockets of this economy that are problematic, and the Fed needs to respect that. And hopefully they do come the new year. At the end of the day, what I've harped on all year long is to stay invested. Just stay invested. This is this is $500 a month. Just $500 a month, buying the S&P 500, going back to 1995, your net right now would be $761,000. It doesn't say, well, I pull out when, this condition or that can. No, it says buy, hold every month. $761,000, 25 years later, 26 years later. This is another chart because we always talk about diversification, or I should say, I don't talk about it that much. I may say something about, diversification off cuff or whatnot, but a lot of times when we hear commentary suggesting that the best portfolio is a diversified portfolio, it sounds good. It does. It sounds astute, makes you sound like you're doing some degree of risk management by being diversified. But the reality is the concentrated portfolio outperforms over time. And the reality is stocks do better than every other asset class. So wherever you are diversified outside of stocks, you have to realize that part of your portfolio, if it's buy and hold, is going to underperform in perpetuity compared to stocks. Doesn't matter what decade you choose, folks, going all the way back to 1821 here. And you look at stocks, you look at the annualized return on bonds, sitting in cash, or playing with commodities. Commodities over the history of their existence have delivered an annualized return negative. From 2016 to 20, that's just 5 years, 10 years, 15 years, 20, going back 200 years, stocks always outperform other asset classes. If I put gold up here, it would be the same thing, except it would have, a lot of negative there. So stay in the market, stay diversified. We don't know when we're going to have another 5% up day like we did after the, that great CPI print. But we do tend to have both the worst days in the market tend to cluster around the best days in the market. And that's what these red and green dots highlight. These are big drawdown days in the red and big up days with the green dots. And lo and behold, they're pretty much clustered around the same, time frames by month and by year. So trying to avoid big drawdowns in the market, you're also eliminating, the big draw ups in the market, the big up days in the market. It doesn't make sense to try and time these things. The best strategy, post-World War II era, buy and hold, 11%. Dollar cost averaging is the next best thing. It's not far behind at basically 10%. It's the best strategy. It doesn't sound sexy. It's boring, right? And nobody's gonna, oh, Brad's the most tactical investor I know. I mean, nobody's gonna say that with a buy and hold strategy. It doesn't say, but it works. Do you want to be popular amongst the social media crowd and financial media crowd, or do we want what works? And what works is buy and hold. It's not easy because we have to suffer the volatility, but that's discipline. I'd rather suffer the discipline than the regret of trying to time things in and out. In years like this year, a lot of these words kind of go in one ear and out the other because, well, I've been repeating them, and we're still in a bear market, so people just are in this mood where it'll never end, and this guy's just going on and on about buy and hold, and my portfolio's down 20, 30, 40%. This sucks today. Well, that's the reality of it. Sometimes, the market just goes down. It doesn't deliver a positive return that year. 2018, the market was down, I think, 6% on the total return basis. But we have to suffer the volatility if we want, those long-term returns. Now, last year, the study was done by S&P Global, and it was awesome because it speaks to volatility and long-term returns. They did this study. Philosophers had long argued that courage is the most essential human virtue, because without courage, all other virtues lie in jeopardy. I can illustrate this with a simple example in the table. So this is stock A, stock B, stock C, stocks D, and the S&P 500. Now look at the peak to trough loss in stock A, 74%, stock B, 73%, stock C, stock D, and the S&P 500. Stock A is Apple. And these are real examples. At one point, Apple dropped 75%. 1999. Stock B is Amazon. Well, there you go, folks. There's Amazon for you. Stock C was IBM. Didn't drop as much. But look at where IBM is today. Since then, stock D was ExxonMobil. It only dropped 25%, but look where ExxonMobil is today. So that's what this study found, is most people would have picked stock D. Most people, knowing the end result. They even knew the end result, that these stocks would be higher than this one. They still picked stock D because most investors don't have courage. They're not willing to suffer a 74% drawdown in a stock in order to see what since 1999, what is Amazon up? Like 10,000%? But most investors aren't willing to stay in the market, suffer the drawdown for the ultimate, returns that lay ahead. This was just a great study that emphasized this. And I'm speaking to Amazon because, look, I'm buying Amazon. Like I said before, deep value. I've been managing cash wisely all year long. I don't know how much lower it'll go or if it'll go even lower at all. Recently breaking $100, recently breaking $90 a share. But cyclically, Larry Williams says it's about to hit the sweet spot in December. And Amazon should have a cyclical upswing from there. Because remember, Amazon's the economy. Amazon is a macro fundamental tool, if you will. If you're studying fundamentals, what better tool than Amazon or Walmart? He thinks there's 100% plus upside. Is he right? Well, we'll find out. But I've, been around long enough to know you don't bet against Amazon. So I like it here. And we'll see what happens going forward. What do you think? Amazon, what are some of your favorite stocks you think going out into 2023? I like TJ Maxx.
I want to start with PayPal, because you've probably noticed I'm not as bullish on that one as you are. I'm not. It's not that I think it's a bad play. It's in the sort of no man's land for me. It's like,
yeah, totally.
It's a crowded area, and that bugs me a little bit. And Amazon area has even become more crowded over time. But of the two, I like Amazon better. And the other one I would never bet against is Apple.
Oh yeah, I think they've proven that. Yeah.
And then I like a mix of the more boring defensive names that I've actually done quite well with this year, like KO. But you're not going to get the big returns on it. It's just. Right. It's just part of that discipline of, okay, let's put somewhere that's, is going to be okay.
Yeah.
Yeah.
I still own Pepsi.
Yeah. And this year, on the advice of my uncle, who's a very, very good investor, I started buying ET for the same reason. That stock's never going anywhere.
And what is
the yield is?
What is ET again?
That's Energy Transfer Partners.
Okay.
Yeah, their yield is not high because the stock's gone down. Their yield is just high. Right. That's how they attract them, and they like to do buybacks.
Right.
So now, if you look at their chart over time, yeah, there's an occasional little dip, but it usually reverts to the mean. And meanwhile, you're just taking in that 10% or wherever the yield is at the time.
That's my Verizon. That's my Verizon.
Yeah, Verizon. Yeah, I've got some of that too.
Yeah.
I like some of the ones that tend to be high flyers when things are good. I've got some Snow.
Okay.
I think that's a pretty good bet, but you got to put up with volatility.
Yeah, absolutely.
And I trade that one a lot, and I don't own a lot of it. What else? NVIDIA.
Semiconductors I've stayed away from this year, but if they can solidify this recent trough as an industry, because I'm not a big, when it comes to semiconductors, I don't like to play the individual stocks. I like to play the ETFs.
Yeah, I've heard you say that.
But yeah, it's hard to deny the valuation here for NVIDIA. It got as low as $112, bounced up to almost 170 within 30 days. So apparently there are a lot of investors who like NVIDIA in and around these recent levels.
And then it's hard not to like Boeing. I think a lot of our team is into Boeing.
Yep,
knowing that it might take a while, but it's going to get there.
Yeah, it's outperformed the last couple months. Well, since earnings, that's one that's also outperformed. So good stuff. I appreciate it. Thank you, Brad. Good stuff. All right, folks, we got to call it a wrap here. Thank you for joining us on this week's State of the Market. Come back next week. Hopefully Brad or maybe Hernan will be back to join us. And have a great Thanksgiving. We won't be here for next week's State of the Market. Because it is Thursday that we do it, and Thursday is Thanksgiving. So everybody gobble, gobble, and come back safely. Take care.
See ya.